In September 2008, the United States lost 800,000 jobs in a single month. 800,000 gone. Not over a year, not over a quarter, 1 month. Families woke up, went to work, and were handed a box for their stuff. Homes went underwater overnight. Retirement accounts that took decades to build were gutted in days. And the wild part, the truly insane part, it did not have to happen, because there were people who saw every single bit of this coming. They had the data, they had the math, they had the receipts, and they were told very clearly to sit down and shut up. This is the story of the crash they saw coming and what happened to the people brave enough to say something. But before we get into the names and the numbers, you need to understand what was actually happening underneath the surface of the American economy, because this is where the rot started. And once you see it, you will never look at a bank the same way again. Picture this. It is 2004. The American economy looks incredible on the surface. Housing prices are going up every single year. Banks are handing out mortgages like candy on Halloween. And Wall Street is packaging those mortgages into these complex financial products called mortgage-backed securities, or MBS. Basically, banks would bundle thousands of home loans together, slice them up, and sell them to investors around the world as safe, reliable bets. Here is the problem. A massive chunk of those loans should never have been approved in the first place. We are talking about what became known as ninja loans. No income, no job, no assets, verified by nobody, approved by everybody. A person with no provable income, no savings, and no job history could walk into a bank and walk out with a $400,000 mortgage. And the bank did not care whether that person ever paid it back, because the bank had already sold that loan off to Wall Street, who had already slashed it up and sold it to pension funds, foreign governments, and retirement accounts around the world. So the bank profits, Wall Street profits, and the risk gets buried so deep inside these financial products that almost nobody can see it anymore. Almost, because here is where the story gets dark. By 2005, the number of subprime mortgages being issued had exploded by over 300% compared to just 5 years earlier. And rating agencies, the companies, whose entire job was to tell investors whether these products were safe, were slapping AAA ratings on bundles of loans that were basically financial time bombs. Why? Because the banks were paying the rating agencies to rate them. Let that sink in for a second. The people grading the homework were being paid by the people who wrote the homework. And yet, almost no one in power said a word. But a few people outside of power, they were screaming. Michael Burry was not a Wall Street insider. He was a one-eyed doctor turned hedge fund manager who ran a small fund called Scion Capital out of California. And in 2005, while reading through the actual loan documents inside mortgage-backed securities, something almost no one on Wall Street was doing, he found something that made his stomach drop. The default rates on these loans were going to explode. He was certain of it. Not maybe, not possible, certain. So he did something that Wall Street laughed at for months. He bet against the housing market. He essentially walked into the biggest banks in America and said, I want to buy insurance on the event that your products completely fail. Goldman Sachs took the call. Deutsche Bank took the call. They all thought it was hilarious. One Goldman trader reportedly asked his colleagues, is this guy serious? Burry sank over $1.3 billion of his investors' money into this bet. His investors panicked. They threatened to pull out. They demanded explanations. Some of them tried to sue him just to force him to stop. His fund hemorrhaged client trust for over a year while he held his position. Then the housing market collapsed, and Scion Capital made $2.69 billion in profits. Michael Burry personally made $100 million. But here is the thing about Burry's story that does not get talked about enough. He was not alone, and the others did not fare nearly as well. Raghuram Rajan was the chief economist of the International Monetary Fund in 2005 when he stood up at a prestigious conference honoring the legendary Federal Reserve Chairman, Alan Greenspan, and delivered a paper titled, Has Financial Development Made the World Riskier? His answer was yes, dramatically yes. He laid out in cold academic detail how the financial incentives on Wall Street were encouraging catastrophic risk-taking, and that the entire system was one shock away from a crisis that could dwarf anything seen in decades. The response from the room? Dismissal. Lawrence Summers, one of the most powerful economists in America, called. Ray John's concerns misguided and referred to him as a Luddite, basically, someone who does not understand progress. The financial press largely ignored the paper. The regulators moved on, and Rajan, deeply shaken by the reception, went back to academia. 3 years later, every single warning in his paper came true. But by then, the damage was already done. Here is what is even more terrifying than the people outside the system being ignored. There were people inside the system who raised the exact same alarms and got completely destroyed for it. Eileen Foster was a senior fraud investigator at Countrywide Financial, which at its peak was the single largest mortgage lender in the United States. She began uncovering widespread systematic mortgage fraud inside the company as early as 2007. Loan officers were faking income documents. Supervisors were actively coaching employees on how to falsify borrower information. The fraud was not a rogue employee here or there. It was institutional. It was policy. Foster reported it up the chain. Then she reported it again. Then she went to regulators. And then Countrywide fired her. They fired the fraud investigator for finding fraud. She later told the story publicly and said that when she brought specific cases forward, managers did not ask how to fix the problem. They asked how she found out about it. Think about what that tells you about the priorities of the people running the show. Meanwhile, over at the Office of Thrift Supervision, a regulator named Daryl Dokow was supposed to be overseeing the very banks engaging in this behavior. Instead, investigators later found that OTS regulators, under his watch, actually helped IndyMac, one of the most reckless mortgage lenders in the country, backdate financial documents to make the bank appear healthier than it was. IndyMac collapsed in July 2008 in what was, at that time, the second largest bank failure in American history. Dokow was eventually removed, but no criminal charges were ever filed. Let that be your cliffhanger for this section. The regulators whose job was to stop the banks were helping the banks cover it up, which raises a question that should genuinely disturb you. If the people in charge of watching the watchers were in on it, who exactly was protecting you? By early 2008, the cracks were impossible to hide. Bear Stearns, one of the most storied investment banks on Wall Street, had 2 hedge funds collapse in the summer of 2007, specifically because of their exposure to subprime mortgage securities. The funds lost over $1.6 billion. Bear Stearns scrambled to survive, and in March 2008, it became clear they could not. The Federal Reserve arranged an emergency sale of Bear Stearns to JP Morgan Chase for $2 per share. $2. A company whose stock had traded at $170 just 12 months earlier sold for $2 a share. Wall Street told itself this was the bottom. This was the cleanup. Everything would stabilize now. 6 months later, Lehman Brothers, a 158-year-old institution, and the 4th largest investment bank in America, filed for bankruptcy. It was the largest bankruptcy filing in United States history. Over $600 billion in assets vanished overnight. The global financial system went into cardiac arrest. Credit markets froze. Banks stopped lending to each other because no one knew who else was holding the ticking time bombs buried inside those mortgage securities. The stock market lost 50% of its value between October 2007 and March 2009. Global trade collapsed. Iceland's entire banking system failed. Unemployment in the U.S. hit 10%. And the people who had spent years warning about exactly this scenario, some of them were millionaires by now. But the rest of the world was in ruins. And here is the part that will make you genuinely angry if it has not already. Not one senior executive from a major Wall Street bank went to prison for their role in the 2008 financial crisis. Not one. The United States Department of Justice brought criminal charges against exactly 0 top-tier bankers, from firms like Goldman Sachs, Citigroup, JP Morgan Chase, or Bank of America, in connection with the mortgage securities fraud that triggered the collapse. Instead, the government handed out bailouts. The Troubled Asset Relief Program, TARP, authorized $700 billion in taxpayer money to prop up the very institutions that had created the disaster. Goldman Sachs received $10 billion. Citigroup received $45 billion. AIG, the insurance company that had written trillions of dollars of insurance on the toxic mortgage securities, received $182 billion. $182 billion of your money and your parents' money and your grandparents' money. And then in 2009, Goldman Sachs paid out $16.2 billion in bonuses to its employees. That was a year after the crash. That was after the bailout. Goldman Sachs employees received $16 billion in bonuses, with taxpayer money still sitting on the company's balance sheet. The firm argued with a straight face that they had to pay competitive compensation to retain their best talent, the talent that had just blown up the global economy. Eileen Foster, the fraud investigator, who got fired for reporting Countrywide's crimes, never received any significant settlement or formal vindication from regulators. Michael Burry, who had been right about everything, told Congress that the incentive structures that caused the crisis had never actually been fixed. And Raghuram Rajan, the man who called it all in 2005, wrote a book called Fault Lines in 2010, laying out exactly how the system was still broken. Almost nobody in power listened to that either. The machine just kept running. You might be thinking, okay, this is old news. 2008 was almost 2 decades ago. The economy recovered. Why does this still matter to you today? Because the structural incentives that caused the 2008 crash were never fully dismantled. The Dodd-Frank Act, passed in 2010, added new regulations, and some of them genuinely helped. But between 2017 and 2019, significant portions of Dodd-Frank were rolled back, specifically the rules applying to mid-sized banks. And in March 2023, Silicon Valley Bank and Signature Bank collapsed within 48 hours of each other, triggering the largest bank failures since 2008. The contagion nearly spread to a dozen other regional institutions before emergency government intervention stopped it. Sound familiar? It should. Because the pattern is the same. Risk gets hidden. Warnings get ignored. Insiders stay quiet because the money is too good. And when the bill finally comes due, ordinary people pay it. Here is what the 2008 crisis actually taught us. Not about mortgage markets, or CDOs, or credit default swaps, but about something far more fundamental. Systems built to reward short-term profit over long-term stability will always find a way to explode. Every time. Without exception. And the people who see it coming first are almost never the ones with the power to stop it. The analysts who tried to warn you in 2007 were not geniuses. They were just willing to read what was actually in front of them. The question is not why they saw it. The question is why everyone else refused to look. And honestly, that is a question worth sitting with for a while. So next time someone in a position of power tells you not to worry, that everything is fine, that the experts have it under control, maybe take a second and ask yourself, who exactly is benefiting from you believing that? The 2008 crash was not a natural disaster. It was not lightning from a clear sky. It was a slow-motion wreck that dozens of people saw coming, tried to stop, and got punished for warning about. That is not bad luck. That is a choice made by real people with real names who mostly faced zero real consequences. If this hit different, drop a comment and tell me which part of this story you had no idea about. Because I have a feeling most of you knew the crash happened, but not how many people tried to stop it before it did. Like this video if you want more financial history that actually makes you understand how the world really works. Subscribe to Yesterday's Secret because the most important stories are almost always the ones they hoped you would forget. And trust me, we're just getting started.